Last Tuesday, while everyone else was complaining about their jobs at the coffee shop, Harry checked his phone and saw another $1,547 had hit his account. Not from his employer, not from a side hustle, from 7 ETFs that pay him like clockwork every single month. And here's what nobody tells you about dividend investing. You don't need to be a stock-picking genius analyzing 500 companies. You don't need $1 million sitting around. You can build a passive income stream with ETFs that do all the heavy lifting for you. But most people get this completely wrong. They chase yields, ignore expenses, and wonder why their income never grows. Quick disclaimer. This is educational content about investment strategies, not personalized advice. All investments carry risk, dividends can be cut, and past performance doesn't guarantee future results. Today, I'm revealing the exact 7 ETFs creating this monthly income, including one yielding 3.73% with just 0.06% fees, and another that's grown its dividend for 13 straight years. Here's the truth about building wealth through dividend ETFs that changed everything for Harry. 3 years ago, Harry was stuck in what I call the high earners trap. Good salary, decent 401k, but zero passive income. Every dollar that came in had a job before it arrived. Then his coworker dropped a bomb during lunch. Why are you trying to pick winning dividend stocks when ETFs already picked them for you? Think about it. Most people approach dividend investing backwards. They buy AT&T for the yield, Ford for the payout, maybe some REITs. Then one cuts its dividend and their whole strategy collapses. But the smart money? They're buying baskets of dividend champions, funds that hold 100, 300, even 500 plus dividend-paying companies. You buy one share, you own a piece of all of them. The diversification alone changes the game. One company cuts, you barely notice. But here's what really matters. Not all dividend ETFs are built the same. Some have expense ratios that devour your returns. Some haven't grown their dividends in years. And some are absolute compound interest machines that most investors completely overlook. Let me show you the cornerstone of Harry's portfolio that nobody saw coming. SCHD, Schwab US Dividend Equity ETF. This isn't the highest yielder, it's not the flashiest name, but the numbers tell a different story. Current yield, 3.73% expense ratio, 0.06%. Consecutive years of dividend growth, 13 years, 13 straight years. Through the financial crisis aftermath, through COVID, through inflation spikes. Look at what's inside. AbbVie leads at 4.45%, then Chevron at 4.36%, Home Depot at 4.30%. These aren't exciting tech moonshots. They're profit, machines that return cash to shareholders. Harry started with $50,000 in SCHD. At a 3.73% yield, that generates $1,865 annually. But here's what most people miss. SCHD's 5-year dividend growth rate is 10.87% annually. Your income doesn't just sit there, it compounds. Break that $1,865 into monthly income, $155. Not life-changing yet, but we're building a foundation. The second ETF flipped Harry's entire approach to investment portfolio construction. VYM, Vanguard High Dividend Yield Index Fund. Now wait, the yield is actually lower at 2.49%. Why would Harry want less income? Because VYM holds 583 companies, 583 dividend payers in one fund. The fascinating part? Look at the top holding, Broadcom at 6.84%. A semiconductor company as the largest position in a dividend fund. The market's telling us something. Then, JP Morgan Chase at 4.15%, Exxon at 2.44%. This isn't your grandfather's dividend portfolio. Harry allocated $40,000 to VYM. At 2.49% yield, that's $996 annually, or $83 monthly. But here's the kicker. VYM has grown its dividend for 14 consecutive years. The consistency matters more than the current yield. Total so far? $238 monthly. Still building. Now for the ETF that most financial advisors never mention. DGRO, iShares, Core Dividend Growth ETF. The yield is just 2.09%. Most income investors would scroll right past. Huge mistake. DGRO's 10-year dividend growth rate, 9.06% annually. 5-year rate, 7.62%. Expense ratio, 0.08%. This fund doesn't chase today's highest yields. It buys companies growing their dividends aggressively. Johnson & Johnson, JP Morgan, Apple, Microsoft, blue chips transforming into dividend machines. Harry put $35,000 in DGRO. At 2.09%, that's $731.50 yearly. Just $61 monthly today. But project that 9% growth forward. In 5 years, that $61 becomes $94. In 10 years, $144, without adding a single dollar. That's how you build long-term wealth, not chasing yield, but chasing growth. Running total, $299 monthly, halfway there. Here's where Harry's strategy gets interesting. DHS, Wisdom Tree U.S. High Dividend Fund. This fund breaks the quarterly payment pattern. It pays monthly. Yield, 3.25% payment frequency. Monthly holdings, 367 companies. The psychological impact can't be overstated. Getting paid every month versus quarterly changes how you view the investment. Top holdings tell the story. Johnson & Johnson at 5.81%, Philip Morris at 5.68%, AbbVie at 5.10%. Healthcare and consumer defensive plays dominating. Harry allocated $30,000. At 3.25% yield, that's $975 yearly. But divided into 12 monthly payments, $81.25 hits his account every single month like clockwork. Running total, $380 monthly. The next piece shocked even Harry. NOBL, ProShares, S&P 500 Dividend Aristocrats. This fund only holds companies that have raised dividends for 25+ consecutive years. The ultimate dividend royalty. Yield, 2.04%. Holdings, 71 aristocrats. Expense ratio, 0.35%. Lower yield, higher expenses. So why include it? Because when the market crashed in March 2020, NOBL holders kept getting paid. When inflation spiked, these companies kept raising dividends. The stability is the product. Harry invested $25,000. At 2.04%, that's $510 yearly, or $42.50 monthly. But he wasn't done. 2 more ETFs complete the income engine. SPHD, Invesco S&P 500 High Dividend Low Volatility. This is the sweet spot fund. Yield, 3.46% payment frequency. Monthly expense ratio, 0.30%. SPHD specifically targets high dividend stocks with low volatility. The top holding? Altria at 3.22%. Then Alexandria Real Estate, Pfizer, Conagra. It's yielding more than treasury bonds while holding equity positions. Harry allocated $20,000. At 3.46% yield, that's $692 annually, but again, paid monthly. Another $57.67 hitting every month. Running total, $480 monthly. The last ETF nobody talks about. SPVU, Invesco S&P 500 Enhanced Value. Yield, 2.49%. Year-to-date return, 12.44%. 1-year total return, 16.19%. This fund crushed it while paying dividends. It's not just income, it's growth plus income. Top holdings reveal why. United Health at 5.30%, Bank of America at 5.28%, Exxon at 4.77%. Value plays staging comebacks. Harry's $15,000 position yields $373.50 annually, or $31 monthly. Let's add up Harry's initial investment strategy. SCHD, $50,000. x 3.73% is equal to $1,865 year VYM. $40,000 x 2.49% is equal to $996 year DGRO. $35,000 x 2.09% is equal to $731.50 or year DHS. $30,000 x 3.25% is equal to $975 year no BL. $25,000 x 2.04% is equal to $510 year SPHD. $20,000 x 3.46% is equal to $692 year SPVU. $15,000 x 2.49% is equal to $373.50 year total investment. $215,000 total annual income. $6,143 monthly income. $512. Wait, that's not $1,500. Here's what Harry discovered about compound growth that changes everything. He reinvested every dividend for 2 years. No lifestyle creep, no spending, pure reinvestment. At an average 8% total return, dividends plus appreciation, his $215,000 grew to $250,000. But more importantly, many of these ETFs raised their dividends. SCHD's dividend grew 8.58% this year alone. After reinvestment and dividend growth, his portfolio now generates $7,500 annually. That's $625 monthly. Still not $1,500. Here's the full truth about reaching $1,500 monthly. Harry didn't stop at his initial investment. He added $1,000 monthly from his salary. Every month, split across these 7 ETFs. After 3 years, initial investment, $215,000. Additional contributions, $36,000. Reinvested dividends, $18,000. Portfolio appreciation, $51,000. Total portfolio value, $320,000. With dividend growth and a larger base, his annual income reached $12,000. Some months pay more, quarterly payers align, some less. But the average? $1,000 monthly, still short of $1,500. The final piece? Harry discovered tax-advantaged accounts. He moved portions into a Roth IRA where qualified dividends grow tax-free. The tax savings alone added effectively 15 to 20% to his net income. Combined with 1 more year of contributions and reinvestment, his portfolio crossed $400,000. Current annual dividend income, $18,500. Monthly average, $1,541. Target achieved. Here's what this means for your financial independence journey. You don't need $400,000 to start. Harry began with $50,000 in just SCHD. The formula is simple but requires patience. Start with quality dividend ETFs. Low fees matter. Reinvest everything initially. Add consistently from earned income. Let dividend growth compound. Take advantage of tax-advantaged accounts. The 7 ETFs aren't magic, they're tools. SCHD for yield and growth. VYM for diversification. DGRO for future income growth. DHS and SPHD for monthly cash flow. NOBL for stability. SPVU for value appreciation. But here's the real secret. Time and consistency beat everything else. Harry's not special. He's not a financial genius. He just started, stayed consistent, and let compound math do its thing. The question isn't whether dividend ETFs can create monthly income. The question is, when will you start building yours? Remember, this is about building passive income streams that grow themselves. Every month you wait is a month of compounding you'll never get back. The market's open tomorrow. These 7 ETFs are waiting. What's stopping you from becoming the next Harry?